Sort of a thing that we never wanted to talk about. They all say the industry would flock to that.
Do what exactly?
The sponsors know. I don't know necessarily that all investors know that. I've done syndicated work for 42 years, so I kind of know that industry pretty well. And during that time, we did about $7 billion. If you identify yourself as what you do for a living, it's not raise money. That's a necessary evil or a hard part of what you do. It's distracting from everything else that you want to accomplish because your core competency is in the area of operating real estate, buying, selling, and operating real estate for a profit. How I lost my hair in the industry, and it happened very, very quickly, and that's when you get to a situation where you got $500,000 earnest money hard, and you get to Monday morning, and I've got to close on Thursday, or the earnest money is gone. Yeah, I'm $1.5 million short.
Yeah.
It's like, so a surety to close is a big thing. When you sit back and you say, well, yeah, that's a pretty big need, that's a big pain point. We can help you with that. Replace an existing member that wants to get their cash and go do something else with it. And somebody could do that for them, so it was seamless to them.
So where do I sign? If it's okay, well, let's start with the sponsors.
Sure.
So the sponsors raised some money, bought some real estate, raising more money. Somebody comes in and says, look, I need to pay for something for my family. I need to liquidate part of my LP position. That's obviously a difficult position for a sponsor, but let's talk about, we'll talk about the solution because that's the good part of it. But what's the difficulty with the sponsors adopting the PREIshare model?
So historically, they've kind of siloed those, their limited partnership relationships with those and so forth. And there's been probably a number of reasons. You know, I mentioned to you in our previous interview, I've done syndicated work for 42 years, so I kind of know that industry pretty well. And during that time, we did about $7 billion during that process. But if you identify yourself as what you do for a living, it's not raise money. That's a necessary evil or a hard part of what you do. And it's distracting from everything else that you want to accomplish because you see your core competency is in the area of operating real estate, buying, selling, and operating real estate for a profit. When you sit back and you say, well, okay, listen, we would like to you need to understand that in that process, you're not fully aligned with your investor's interest. And part of it is because of this, I don't raise money for a living. I invest money in real estate for a living. And you say, but there's people in here that, a lot of people won't invest with you because it's not a liquid product or whatever. And you're not dedicated a lot of your resources towards raising capital. You don't want to have to do that on a continual ongoing basis. So part of it is that liquidity factor that we had discussed earlier,
right, is
providing liquidity makes the raise easier, so forth. So you have to spend less time, more people are more interested just by providing liquidity to those limited liability investors. But how I lost my hair in the industry, and it happened very, very quickly, and that's when you get to a situation where you got $500,000 earnest money hard, and you get to Monday morning, and I've got to close on Thursday, or the earnest money is gone.
Then you got to scramble to fill the boots so you can close.
Yeah, I'm $1.5 million short.
Yeah.
It's like,
that's not exactly finding, due diligencing, underwriting, executing, and operating a real estate project.
Well, that's a worst part of raising your own capital. You know, and so it's like, that's a nightmare. It's like nobody goes to lunch, nobody goes home tonight.
Yeah.
We're dialing for dollars.
Yeah.
So PREIshare said, listen, if you will unsilo, allow us access to those, your limited liability members or LP interest, so that we can make that part of it liquid. That'll make your job easier. But more importantly, is that we can provide funding for you on a short-term basis. It's fairly costly because
So typical bridge. Yeah.
sure, but we had discussed before the opportunity or the problem that it solves is also pretty immense. You know, you could have, I've had $500,000, $600,000, $700,000 worth of earnest money. It's gone hard, you know, and it's like, you want to borrow some expensive money from us for a little bit, just in way of form of equity that maybe costs you $30,000 or $40,000. That pretty pales in significance to losing the earnest money deposit.
Yeah.
So a surety to close is a big thing.
Yeah.
So they love that aspect. And then today we're seeing a lot of these guys coming in these economic conditions saying, man, my interest rate, we just re-upped our loan, you know, because we had a review of our debt. And they come back and they say, listen, not only can we not make distributions to our investors any longer, but we're not being able to cover our debt coverage ratios. So all of a sudden they're in technical default.
And the covenants kick in.
Yeah, all the loan covenants kick in. And so when you sit back and you say, well, yeah, that's a pretty big need. That's a big pain point. We can help you with that. Now, you can either do that with a cash call to your investors, or we can provide you pref equity, which means we're going to slot in behind your debt. So we're going to get paid first. But we can alleviate, at least provide enough cash to cover your debt coverage ratios, or provide assurance of that to the banks, which most banks will accept that, or lenders will accept that. So those are the two big things that we add to the sponsor package. What we ask for in exchange is that you take the siloing away from your investors and let us be able to get to them if they want to become liquid. But
so the bad news, as I termed it, that we want to talk about, is not really bad news. It's just conditions, right? So bridge money is going to cost you, and we'll be there to help you close, and we could potentially liquidate an LP position from an existing LP, but we need to get our pound of flesh. So on the one hand, it's a little rough, but on the other hand, it makes it easier for you to conduct business.
yeah. So on the other side of that, in risk management, when you look at it from that standpoint, anything that's going to provide you with an increased rate of return always comes with risk.
Yeah.
So if you're saying, if you start off with the sentence with you're in trouble, and you're pricing into that trouble, you better understand the cause of that. Why didn't you get your raise done in an allotted period of time? What was wrong with that? So some of it is not really risk
Associated with risk, yeah.
And some of it might be. This might not be as good a deal, because if you have
A bad deal, right?
300 or 400 people look at it and say, I'm going to pass,
There might be something in that, right?
there might be something there that you need to be aware of. Same thing as if you go and provide pref equity to clear up insolvency issues and the cash flows. If it's just debt related, and that's fixable over a period of time as credit markets loosen up and come back to reality a little bit, whatever that's going to be, then you look at it and you say, was there any factors that would have led to the change in credit other than just the capital?
Right.
Calling in the debt for review. And then you got to look at what was the status of the NOI coming into that, and all of the other elements. Occupancy, yeah. And was there any shifts in any of that? And if the property was performing well going into that, and you can isolate it down to just the cost of that credit, then you'd say that's a fixable problem.
Yeah.
But there's so many other times where you just see, I made a bad market decision. You're not fixing that.
No.
You
So one of the things we talked about, and I thought it was a nuance and insightful, and I think I said it. It's kind of a joke.
Yeah. I know you're an insightful guy. I know that.
This pun on words, is that during the time that a sponsor is raising money or fund, there's really no interest in monetizing an incumbent investor just because they need some liquidity. So it's a distraction.
It is.
And I mean, let's call it what it is. We have a current LP investor. We're getting our management fees and our promote, or whatever the compensation structure is. They want to give us they want us to give them the money back in some form or another, so they have some liquidity. And not only does that distract us from raising money for the next fund, now we've just lost the fees and the promote on that. So,
Right.
So that is a problem that is the sponsors experience regularly. Just walk us through how PREIshare is going to help solve that.
So we're talking about the investor liquidity.
Yeah.
Yeah. So that's primarily what we started with.
Yeah.
That was wanted to be our core focus and our core competency. And so when you look at it, you hit all the key points from the sponsor's point of view. It's like, really, I'm going to take cash from a current raise and I'm going to backfill existing investors. That's just not going to happen.
It's not an advance.
No,
Yeah.
no, it's counterproductive.
Yeah.
And you're already looking at something that it's an ancillary business to what they're already doing. And no one really makes money at the promote unless you are in that business. Mm-hmm. And then that's pretty lucrative business. Yeah. When you come in and say, all right, so what's the issues about replacing that capital? There's really only one issue that you got to be aware of. And that is that accredited investor that's replacing my existing accredited investor? That's the big risk for the sponsor.
Good point.
And the reason being for that is because if you put somebody that's not accredited into that, it could be the grounds for the SEC to unwind the whole fund.
The whole thing, yeah.
Yeah. So we're not going to accept that liability. We're going to say, look, here's, been verified or some third-party services has said this individual is accredited. That final decision is you. That's the only thing that you can't dismiss yourself from. Mm. But other than that, with CRM programs and people who want to use this as part of the PREIshare model as part of their functionality into their investor relationship programming, they could just change your capital stack.
Yeah.
Seamlessly. You would never know that it happened. You just got a new name.
One pocket to another. Yeah. So the barrier, as I understand it, and there might be others, but I don't think so, but tell me if I'm wrong. From a sponsor perspective, they just simply need to recognize that LP interest as a security in their operating agreements going forward for you to be able to trade them.
The sponsors know that. I don't know necessarily that all investors know that. So they think, well, I'm invested in real estate. And the truth of the matter is you're not. You're invested in a company that owns the real estate.
Right.
In our industry, most of us that are syndicated for years, we would call them SPEs, special purpose
entities,
which could have been an LLC. It could have been any number of vehicles.
It's a corporate structure,
Yeah, some sort of corporate structure. And that's what you invested in.
Yeah.
And as such, that's a security. Now, if you want to test the other side of that, and it used to be popular a few years back, we used to do these things called TIC structures, tenant in common. Mm-hmm. And that meant that everybody was a general partner. And it meant that if you wanted to sell something, all of you had to agree to sell it. I mean, everybody
at the GP level,
Yeah. And if you had 30 people in there, because they were all general partners,
he couldn't get 2 to agree, never mind 30.
Yeah, if you were buying lunch and said, if you could just decide where we're going to go to lunch, you'd never get a consensus up. You'd starve to death.
Yeah.
So that's why those kind of things never really worked. But in the case of these SPEs that are either have got limited liability members or limited partners in them, that's a security interest in the company that owns the real estate.
Yeah.
And so those are transferable. So everybody knows that, but I think sponsors don't necessarily explain that to them because they don't want that you yeah, technically we could transfer this and not have to sell the real estate to get you your money.
Right.
And so they don't necessarily want to do that because that's going to fall on them.
Yeah.
And if you look back, Arthur, at some of the interviews we've had over the last few months with these sponsors, it's sort of a thing that we never wanted to talk about. They all say, if somebody would do that, the industry would flock to that. Somebody that could actually
Well, let's be concise about that. Do what exactly?
replace an existing member that wants to get their cash and go do something else with it.
Yeah.
And somebody could do that for them. So it was seamless to them.
Yeah.
Then,
So where do I sign?
yeah, everybody would say, yeah, absolutely, let's do it. The only caveat I'd give you to that, and it's an interesting one, I didn't see it until you start seeing this market downturn, is if you open up liquidity and there's a lot of bad press about real estate, which there currently is, and people start looking at it, it's tantamount to a run on the bank, right? You can get a spiraling down effect where people say, I need to get out. And if that goes onto the listing hub or we start pricing accordingly to that.
All of a sudden we see a rash of people bouncing out from a particular sponsor's
Yeah,
fund.
yeah.
Wow.
So that requires some careful message management and so forth,
Yeah.
and how you do that and how it goes onto the listing hub, which we talked about in our last interview, which is where you can advertise those sort of things. But what you don't want to do is you don't want to have a spiraling effect of that asset value.
Why did everybody sell this particular LP
Yeah,
interest or their LP interest in this particular fund?
yeah.
You know, it's just,
Suddenly you had 30 investors in this and 10 of them want to sell it
yeah,
properly.
yeah.
Yeah. So that we have to kind of manage that.
Yeah.
But
And if you really understood the underlying investment, that could spell opportunity, but that's a whole different thing, right?
for us, it does.
Yeah.
For PREIshare, it does, because we want to buy it at the best pricing we can for our investors.
Yeah. Let's move on to the investors in the program, the people who want to invest on the hub, on the platform. Let's talk about the risks there, and let's talk about, move on to the why it's good for them.
So for the investors in our fund, you have the standard risks that are associated with real estate. You have the regulatory concerns, the concerns of the credit markets, because we're very credit dependent. We use leverage as part of the way we get better returns. Then there is macroeconomic concerns that you would look at, slowdowns in the economy. I used to do multifamily. Jobs report was very important to me. Matter of fact, I used to look at the major employers in my market, and if they're publicly traded, I'd look to see how the stock was doing because I was worried about my employees who were working there, not
Being able to pay the rent.
yeah.
Or fill the vacancies, right? Yeah.
Right.
Yeah.
And it's not that I was invested in the stock. I was more worried about
Yeah.
layoffs. But so you have those, and then you have the micro levels, because all real estate's local. So you have, what's going on in the local economy, the regulatory concerns. So it's the same set of problems or concerns, but just step down to the local level. So those are the standard elements, and we've got them we disclose those in our PPM when it's read.
So no different.
No, no different.
Same risk.
Yeah, same risk. But what's different about the risk that we bring that's unique to us, and I just want to talk about it openly, this has never been done before. Now, we've tested this now. We've been at this for 14 months and invested a lot of time, a lot of money, a lot of energy into it, tested all aspects of it. And I think the market, what we're going to do is going to be disruptive because it's going to force to be adaptive. A disruptive change in any mechanisms or systems comes not because people wanted it. Maybe it's a better mousetrap, but they were forced to it. And a lot of changes come about that way. And this is one of those ones that, for example, if I tell you as an investor and John Doe over here is your sponsor, and I say, hey, Arthur, we can provide you liquidity. Yeah, I really need that right now. The new Ferrari's out. I got to have one.
Yeah.
And you say, okay, well, we can write you a check for it, and here's how much we can give you, but you got to go talk to your sponsor and say, why don't I have liquidity in this? You're going to force that issue with that
Yeah,
sponsor.
it's going to be driven by the people in the field, so to speak.
Right.
That people are feeling the pain. You know what struck me, and don't mean to interrupt you, but that the real estate business is such a massive business. I mean, in terms of the overall GDP of the country, I don't know what the number is, but I'll make it up. But it's big.
Yeah.
And so what struck me was that being forced by those LPs that want liquidity to the sponsors, this could scale rapidly.
That's a risk factor.
It is a risk. So how do you keep up for it, right?
Yeah. I've known over, because I've done several startups.
Yeah.
Matter of fact, I'm just a startup CEO. That's really what I do. I've kind of got this seat right now as an interim. But I know for a fact there's only two ways that I can see you really kill a business. You either starve it to death for lack of opportunity, or you choke it to death by trying to bite off too much opportunity. Yeah. And that scares me, just because the opportunity could scale very, very rapidly. Yeah. And being able to respond to that might be a bit of a challenge.
Yeah.
And it sounds like, wow, that's such a great place to be.
A high-class problem, yeah.
But it's not.
Yeah.
Because then when you're starting to move a lot of capital, the picture doesn't become so clear anymore.
Yeah.
You know, and it's like, you don't have the luxury of the level of scrutiny as you deploy more and more capital to scrutinize. And we're scrutinizing on a national level, and we're scrutinizing on local market levels.
Right. So you might make more mistakes.
Yeah. So that just requires fortunately, there's some really great technology. We were anticipating doing most of our underwriting just manually, just analog. And we've had some brilliant people come to us recently and said, we can do that with AI. And then you can verify the work of the AI algorithms, the neural nets. All we got to do is just learn what you're doing. You know, what are the underwriting process? What is that about?
You might miss a few good ones, but you'll get eliminate a lot of the work associated from saying no in an analog way, right?
Right.
Yeah.
And it takes the human element out of it. You can't overwhelm it.
Yeah.
You know, and if it did nothing else but kill the things that should have been killed,
yeah,
that's 90% of the battle.
Super interesting. I know tech's advancing, and of course you can't have a conversation without talking about ChatGPT, AI, and all that business. So it still boils down to, I don't know if you agree with this often shared refrain of you make money in real estate when you buy it.
Oh, that's true.
Yeah.
That's absolutely true.
Yeah.
Yeah, because you only get one chance of buying it right.
Yeah.
After that, good property management can fix anything else. And that's part of one of the things that's kind of interesting about this model, because the more I've looked at this, and I've spent a lot of time studying it, realizing the need has been there for the 42 years that I was a sponsor. But then as I start thinking about what problems does this solve, there is just a plethora of problems that it solves.
So the solution, let's just look at it in those terms, for this PREIshare solves for the investor, probably is best framed out as the opportunity, right? So I'm going to invest in PREIshare so PREIshare can take my money and do things with it, right? And so let's just a couple of examples of the things that why I might be willing to vote with my checkbook, not the operating company, but as an investor in having you deploy my capital.
Well, we just talked part of that. It's extremely scalable.
Yeah.
And it's scalable at a very good rate of return. There's a little higher risk rating to it, but as we talked about in our previous interview, a lot of the risk rating goes away when you start talking about the diversity of the assets, which is part of why it's scalable, but you have diversity of location, diversity of sponsor, diversity of asset class. And if you stay diligent in your underwriting, stick to your exact underwriting requirements of those, and ferret out those things that should not be looked at. Like right now, I could tell you right now, anything that was bought in the last 2 to 3 years probably shouldn't be looked at.
Yeah.
That might have to go through a foreclosure process.
Foreclosure, yeah.
To correct how it was invested, because we talked about things that were bought for higher than its replacement cost, that were 80s and 90s vintage properties. That's bought wrong. To answer your question, those were bought.
And the wave of people coming out of COVID
Yeah.
and getting excited about things and the low interest rates. Yeah.
Yeah. And that was the other thing, is when interest rates went down, it's like, well, how do you take advantage of that? And well, you invest in real estate, because then you really get the value of leverage.
Yeah.
And so I've done this long enough to know that you can just see these signposts coming up. Low interest rates, stock market's a little wonky, expect too much cash to come into the real estate industry and really screw it up.
Inflate everything.
Inflate everything.
Yeah.
Yeah. And it's like, I don't care if it makes any sense. It's real estate.
Yeah, it's real estate.
It'll turn around, And an example of that was years ago when I was still getting a haircut. My barber, who had given me my first haircut, Cal, the last one, one of the last ones he gave me it was a horrible haircut. It was just horrible. And Cal couldn't see, which is kind of not a good thing for a barber.
Not a good thing. Yeah. There's ears and stuff.
Yeah.
Yeah.
Well, besides that, it looked like I'd gone through chemo or something. When he got done, I looked at it and said, Cal, that's a horrible haircut. And I'm not going to pay you for it. And he looked at it for a minute. He squinted around, looked at it, and he goes, yeah, it's pretty bad, but in a month, that'll be a good haircut, and you're going to owe me the money then.
Yeah.
Just save the trip. And it's kind of the same process in real estate. We get in this mentality that the market's good and will stay good. And in a month, that will be a good haircut.
It'll work itself out.
Yeah. And it's like, no, you just bought it way above the replacement cost. So you bought it wrong. Time is not going to correct the ills of that haircut you just took.
In fact, it's going to go the other way.
It's going to go the other way.
Yeah.
You're going to get a correction, and you're going to realize that was a big mistake.
I think it might be valuable to just, if you don't mind me articulating it a second, how I see the benefit a couple layers deeper on the diversification story, as you suggest. And this might not be a popular comment for the sponsors, but I'm an LP investor and a sponsor. They're buying whatever real estate they're buying. Let's just say it's multifamily. And there's some diversification in location and towns and cities and that sort of thing. The investor that was going to invest in PREIshare, the diversification's exponentially more, if I understand it properly, because I get the diversification within the sponsor that it would arguably otherwise have, but now I'm invested incrementally on liquidity events that I provided across multiple sponsors and multiple jurisdictions and multiple towns and cities.
Correct. So you've got little small pieces over the whole spectrum. And as you said, that is a very large spectrum, because real estate kind of is, in one shape or another, is the foundation of all economy. You either got to dig something out of it, plant something in it, build something on it. But that's kind of where it all comes from. And, even people that have totally unrelated businesses to real estate still housed there. And you can say, well, yeah, maybe not so much in these days because they're not going back to the office. Well, then all of a sudden you got to look at the housing industry, because that's where they went. So those are big mega trends. And the market will make its own corrections based on, you just make the investment with the market, and it will make its own corrections as it moves along. So that's the one aspect. But one of the things that you just touched upon, I think that's one of the most interesting aspects of this, was sort of unintentional. But when you look at it, you say staring right back at you, and that's a very good aspect of this, is that it has, because you're mostly investing mid-cycle, and you have a lot of these little investments. So it's not like I made a $10,000 or $10 million bet here that matures 5 years from now. I made 100 or 200, 100,000 bets or $200,000 bets by buying those fractional interests, or I made a few bigger bets on providing pref equity or providing a top off, which is just another form of pref equity. But they're all jumbled together, and they're going to liquidate. And they're going to liquidate over that next 10 years. Matter of fact, the whole portfolio will generally, if you look at how it models out, all of the assets will rotate through it in about 3 years. So
the duration benefit is not only embedded in the model as an investor, it's something that's going to happen no matter what, because you're buying something that might have 3 to 5 years left
right
on duration, right?
So
and whatever expenses are associated with the acquisition of that and the time it took to mature, those have been paid by somebody else.
correct. Plus,
Is that fair enough?
yeah, no, that's a very fair statement. Yeah. And the acquisition costs are not normal associated acquisition costs. Remember, this is not real estate. Yeah. It's a security. And there is no broker dealer involved in this. It's just a customer to customer, investor to investor transaction. So it's just, they work out the details of that. We just connect them. Or if they buy from us, there is no transactional cost to it. Or if we buy from them, excuse me. But the other aspect of it is that because I'm a pretty fair real estate economist, I know the econometrics of real estate very well. Spent a lot of time studying that, and even wrote some course material that's being taught at the university levels around that. I have a pretty good crystal ball for about 2 years out, because real estate is a very inefficient market system. If you're going to get hit with the punch, it's coming from the parking lot. You can look out the window and say, that's going to be here in about 3 hours. I got plenty of time to duck, because you can see changes coming in. One of the big factors that we're experiencing right now, you can see changes coming in the credit markets. You can see excessive amount of equity coming into it, which we've seen in the past. Things are going to get overpriced. So market timing issues like that, 2 to 3 year cycles, which is usually about a third of the total real estate cycle, which usually run between 7 to 10 years. Pretty easy to call, at a pretty high predictability rate. No one has a crystal ball 5, 10 years out.
It's too much. Yeah.
Too much. And if you're committed to that investment for 5 to 10 years, then you run that risk of anything that's past what's immediately in front of me, what my headlights can see on the road in front of me. Anything past that is an unknown. Yeah. And that's what really creates risk.
And so to translate that into how it'll benefit the investors in the PREIshare program is that they have an opportunity to invest mid-cycle, have the whatever 2 years it took to get the thing stabilized, let's just use those words, and they don't have to worry necessarily about 5 to 7 years out.
All right. See, the best way to eliminate risk, sounds simple, but no one really thinks about it. Take money off the table.
Yeah, take money off the table, yeah.
Yes, and if you have that opportunity to continually do that, and if the whole portfolio turns itself in 2 to 3 years, you're constantly, every quarter, you have a chance to pull money off the table.
Yeah. Okay, so that I think is, so if somebody wanted to vote with their checkbook, and it's just a matter of investing into the program, so that's pretty straightforward. Look at the documents, send your money, and then the question is that then to get over the finish line for them to do that, they just have to be confident in your skills in deploying that capital. It's
Correct.
like anything else, right?
So, yeah, you can vote with your checkbook, but we're not asking you to fund the total commitment up front. So if you come in and said, look, I'd like to take 5 million of that, or I'm committed for $1 million myself. The first thing that we're going to say is, okay, we'll let you know.
Don't send us any money yet.
Yeah, don't send us any money. And we'll talk to you quarterly. We'll let you know what's coming up, what we think, what the opportunities that we're seeing. And then you can participate in that next round of investment on a quarterly basis. If you don't, then we'll backfill you with somebody else. And, as long as they keep investing, then we'll keep making those quarterly offerings. But the reason we do that is because, A, we don't want cash on the books because it's
friction.
Yeah, it's friction.
Drag.
Yeah. So we'll look at what's coming up, and then you can make your investment. So if you come in and say, I committed, so I did. I committed for $1 million, and so Kent, the fund manager, came back to me and said, "First, prove that you're accredited." Well, it's like, what a jerk, But he's compliance oriented. Yeah. So okay, I'm accredited. Gave him the paperwork, and he says, okay, now I need a check for $100,000. And the reason being is because that gives him the first 2 quarters of what he sees that's out there, that's available, and then beyond that, then I can make decisions further. So as he comes back and he says, next round of participation for this quarter is another 100,000 or 50,000 until you get up to it. And if you look at the model that they've got, there's a chance you might not get all of that money committed.
Yeah.
Because depending on your reinvestment rate and their deal flow,
sort of roll it over, yeah.
You just keep rolling it over. If the returns are as good as they look like they're going to be, then you just continue to roll the cash. And if not, if they start falling behind or something like that, or there's real concern about the model itself, as they liquidate over that 2 to 3 period, you just decide to draw that cash back. It's totally option to the individual investor.
And so the decision point is, do I want to make the capital call as the investor this quarter or not? But I'm not making a decision on what the investments is, what the investments are in that, whatever you're buying that quarter.
Right. So, and that's not punitive. It's not like a cash call. It's not like, well, yeah, if you don't do it, then we're going to charge you, somebody else to make the investment for you. What we would do is that we think we've got enough interest on this already, based on talking to our past investors and so forth. What we'd do is if they came to me and said, hey, Mike, we need from you 75,000 for the next quarter. And I say, you know what, I think I'm going to sit this one out.
Yeah, you just pass it.
And then what they're going to do is they're going to take me and put me at the bottom of the queue. And then somebody takes my spot. And so they make that investment. And I don't get a chance to start investing again until I cycle.
Your time comes, yeah.
Yeah, until I cycle up and they need an investor to take somebody that didn't make that, their cash investment for the month or for the quarter. So it's pretty easy. This has got to be the most investor-friendly structure because it has built-in liquidity to it. You can decide if you want to take your principal back, take gains back, or if you want to take the distributions on returns.
Yeah, I did note that. It is pretty easy.
Yeah.
Yeah. Okay, so let's talk about the operating company now. And I'll go ahead, if it's okay with you, and just say that just like any other operating company, there's execution risk. And it's execution risk on a structure that is new, nuanced, run by people with lots of experience, nonetheless, but the execution risk is there. So let's just take that off. What else? What are the risks?
Well, for the company itself, you'd have to look at, if this is such a great disruptive technology, who else is going to enter the space? That doesn't have much effect on an investor. Matter of fact, that just gives them options. It just says, all right, well, let's see who executes better.
Yeah.
Yeah, and so that has really no effect on the investor so much. But I would say I still have some concerns about regulatory. You know, if this turns into the marketplace that logically it would become. You saw it, I saw it.
Yeah.
When anybody sits and thinks about this for a minute, thinks, oh, this could be a massive marketplace.
I mean, it's easy to take it there, right?
Yeah, it is. It just all of a sudden just goes there quickly because you realize there's going to be a high rate of adoption for this. And then you start thinking, well, what will the regulatory questions that will arise from that? And how much regulation is the SEC and other local securities for the states? How much regulation is there going to put on that? The only thing that really they do right now is there's a few laws on the books that says if you replace an existing investor in a limited liability or a limited member, you may lose the voting rights. And it was only put there just to protect the existing members that were in. But those could be contractually superseded. And so I start thinking, if you just do a thought process and you think about, what if you have these really high levels of turnover inside those LLCs or the SPE? How is the state and federal government going to start looking at that as an unregulated transaction?
Listen, I tend to be hyper sensitive to being uber compliant because I've owned a broker dealer, and I'm also in a position where people think that I might be getting paid a success fee, and I'm not.
Oh, I understand. Yeah, I understand that completely.
And so I just don't want to get pulled into that argument because it'll do nothing but cost me money, even if I'm innocent, right?
Understood. But you asked the question.
No. I did, and I happen to think that you're not going to get the regulatory scrutiny that you think you'll get, but it's just because I've seen so many things, right? On the other hand, regulators are understaffed and miss things, but they're also scrutinized for missing things. So they'll tend to put you in a spot where they say, we don't know what you're doing, but we're not going to miss this one, right?
Right.
Yeah.
Well, and you've seen that in disruptive technologies recently, where it's like the biggest hotel company in the world is not a hotel company any longer. And in the process of doing that, Airbnb broke just about every kind of zoning law you can imagine. And it's like it got away so quick from the local
good example.
Regulatory.
Yeah.
Uber. I used to live in New York. I know how much those guys paid for their taxi cab medallions. Some of those are up to $1 million.
At the height, I knew somebody that owned 35 of them.
Yeah.
Yeah.
And that went away overnight. And it went away in such a way that it shouldn't have, because there was no regulatory control over the drivers.
Yeah.
I mean, you didn't know if you were the guy who was hustling drugs 5 minutes before he picked you up out of the same car.
Yeah.
So that was disruptive. So it completely got away. But just because that the industry might get away from the ability of regulators doesn't make it necessarily a good thing.
No, I agree. Yeah.
I can see some really areas where this could be exploited, and the industry is going to have to protect itself from that exploitation.
All right, so to tell us, that is a fair disclosure about one of the things you're concerned about.
If you look at our webpage, the first thing we talk about is transparency. And the best way to protect yourself against fraudulent activities and misuse of systems and exploitation of those systems is to make sure everything's transparent in it. And all of the disclosures. When I first started as a real estate sponsor, I always thought, boy, I'd read those disclosure statements and it's like guy, if you invest with this guy, you're an idiot.
Yeah, right.
You know? And I was like, really? Does it
Just
happen?
like the pharmacy commercials, right?
Yeah.
You'll bleed out of your ear.
Yeah. And it's like, those are all worse symptoms than what I'm experiencing. But same thing. So, but that over the period of time, I realized that was there to protect me and it was there to protect the industry. And so when you start with something that's requires that level of trust, and also you have to police it yourself, so the bad players can't get involved in it. I mean, they sort of do, but it's not necessarily by intention, but sometimes just incompetency.
Yeah.
You say, what's your best defense for that? A lot of scrutiny and total transparency of that scrutiny.
Yeah.
You know, and the first thing when we sit down with PREIshare, first thing I had to acknowledge to myself is, all the time I was syndicating real estate, my interests were not aligned with my investors.
Falling on your sword out of the gate, huh?
Yeah. And it's sort of like, how do I fix that? How do we fix that? And then how do we, if those who are employed to regulate that can't regulate it, how do we as an industry regulate it? You know, and that's maybe the better challenge. The better answer.
Yeah. All right. So how does one participate in the operating company?
So right now, the only participant is myself in that. I'm tired of it. So I would really like a partner in there. Right now, I don't see a lot of value in it currently. If I was going to give so the operating company, which is PREIshare, will issue the fund. That's where the great opportunity is. That's where a lot of opportunity is. PREIshare, the parent company, really only has the listing hub that would generate a cash flow. And then there's some minor areas. Like right now, we're being monetized on YouTube, which we've only been doing this for a few months, and we're already starting to make money. But right now, if I were to draw down the cash that we've made with YouTube in the last 3 months, I'd have a hard time buying you and I lunch with it. So, but eventually we think that could be a profit center as this grows and we become more authoritative. But the listing hub, the plan right now is to $500 to list your fractional interest on there. Same thing. We're not a broker dealer. You know, you just list it, and all we're doing is charging an advertising fee. And you say, that's not a significant number. And then you say, but how scalable is this? You know, that would be like saying, I'm going to get $500 on every trade that's done on the New York Exchange suddenly, if it's able to scale to its full potential. And you don't get a lot of other exchanges in competition with it. So that could be very, very profitable. And then, of course, we do have a fee associated to manage the fund, which is only 1% management fee and then 10% on the promote. And so, and that's so much less than every other sponsor charges. But when we looked at it, we're not managing the asset. We're just underwriting and keeping the deal flow. So we were able to go down to that number. But to be honest with you, Arthur, I think that's going to be a very, very big number. And if somebody wanted to participate in that, you know, we could definitely talk to somebody that wanted maybe come in on the corporate level. Although right now we're just you need to understand, we're not a C Corp, we're not a registered, we're just a limited liability corp.
Yeah, all that stuff can be changed and fixed as time goes on. No, I think this demonstrates well where the risks and the opportunities are in most of the stakeholders that are involved here. Since you brought it up, let's tell the audience about Fundication Show.
So when we did this, we realized that there had to be two aspects to the company. There's the real estate side, and that's what we started with. Matter of fact, it was just a bunch of real estate guys that sat down and talked about, let's go do this thing. And then it was like, oh, it's a new concept. How in the world are we going to tell the world about this? You know, and so in the past it would have been, well, put it in the, you know, newspapers or the financial magazines or whatever. That's not how things are done today. And we got painfully reminded of that right out of the gate. And so we realized that two things about this other side of the company. And the other side is the marketing side. Fundication is part of that. And the first thing that we realized when we did this is that we had collectively about 40,000 accredited investors that we'd been working with when we combined all of our lists together. And we thought, how do you monetize that? And this gets back to this viability question. And we said, well, if I was a sponsor today and somebody gave me a chance to come on a program that has 40,000 accredited investors following it, and you were not going to charge me for that, all I have to do is include a clause in my operating agreement that says we get access to those guys if they want to get out of your deal, but I'm going to let you be on the show for free.
Sounds like a good use of funds.
Yeah.
Currency being time.
Yeah, right? Absolutely. Because you come here and you do that for free. Yeah. I used to do these investment platforms, where you would go and you'd put your product on like Real Crowd and CrowdStreet and some of these guys. And it would cost me $30,000 to get the same exposure. And it's like, yeah, well, we can do that for free, but the caveat is we want access to those, anybody that wants to sell their fractional interest out of your investment.
I don't want to open up your kimono, metaphorically and otherwise.
No one wants that.
But we do know, as you've told me, that no one said no to that.
No, they have had a concern.
Yeah,
and that if things are going bad, do you really have to expose that?
Right. Well, that's
so we've had to modify some of our policies to protect them. If they're one of our approved investors, that means that we really have that double challenge because they are an approved investor, so we do have to protect their reputation.
Yeah.
Doesn't mean we don't disclose. It just means that we have to get invested to find them a solution.
I would not necessarily taking any advice that I would give, but I learned a long time ago, disclosure's king.
Oh, it's everything. I used to think that was the biggest pain in the world, and now I cling to it like a life preserver.
Yes.
Disclose everything, and then disclose it again, and then disclose that you disclosed it. And no matter how, and the worse it gets, disclose that more and more.
Yeah, right. No, you put it right out there.
Yeah. So, and that's kind of the issues. See right there, that is one of those kind of question marks. When you say, if there's a fund that's in trouble and there's a high rate of trying to get liquidity out of that.
Run on the bank.
And it's run on the bank. Yeah. All of a sudden you're in a kind of a regulatory concern. How do you stop that run, yet stay transparent?
I mean, they've been talking about this in the news and how the FDIC and so forth are trying to prevent that from happening. And, it's a complicated problem, right? But similar problem as you suggest.
Yeah, and the answer has always been sort of full credit and faith to the U.S. government saying, we got you.
Hang on. Yeah.
And that's kind of what stops that. But, we just saw one bank transfer hands over a weekend.
Silicon Valley Bank had it over a weekend. Signature Bank happened over 2-3 days.
Yeah.
I don't need to put any more bad news about what else is coming.
Yeah.
All right. So can we talk? This has been super helpful. I'm really grateful for you having me here. But I want to talk about one more thing before we jump. Are you willing to give us your 42 years and some change real estate experience on where you see this all going in the real estate market? We'll just talk about commercial.
So a lot of the problems that we see right now in the real estate market, because it's these series of Gaussian curves, and it's how much money's flowing into it versus how much is coming out of it, and relative market conditions. I see that stabilizing. My biggest problem, to a certain extent, you're always going to have that cyclical, but my biggest concern has always been, for the 42 years that I've been in the business, is that this is such a unorganized market system around real estate, that there is, it's a long time to add new supply. You have to go through entitlement processes and everything else, and it takes forever when you want to sell something to make it liquid. And if you got partners, that further complicates on agreements and pricing and so forth. So it's a very inefficient system. And by acknowledging just the part of it that can be made efficient, which is the buying and selling of those security interests, I think it will change quite a bit. I think the cost of equity will go down quite a bit. I think we touched upon that in our last little bit. You'll get better real-time intelligence because the market system will be able to provide that.
Actually, it wouldn't just be an estimate of what the value is, it'll be a real number.
It'll be a real, absolutely, market-driven number to the moment. Which is, I've always envied the securities markets because they have
every
that.
Every day. Right?
Yeah. And so you get real-time intelligence or near real-time intelligence, which I think that's going to be very, very beneficial to the market system. Anything that makes it more efficient. Back when I was doing econometric models to try and predict which market we wanted to invest in, I had so little data to deal with. And so I had to look at anecdotal evidences. And I mean, this is how arcane it was. I would say, get out the local newspaper, and if I said that to a 20-year-old today, go, what the hell's a newspaper? But you say, get out the newspaper and measure how many column inches of jobs and how many column inches of houses or apartments to rent.
Well, yeah, what's the delta?
Yeah, what's the delta? Yeah, what's the? Yeah. And so those were some of the tools that we were using then. When I trained my protege before I left the company I sold, he was getting near real-time information off of programs that were reporting off of software that would do property management. Yeah. But it wouldn't give you buy-sell information. It would just give you performance information on the properties, but geographical location and asset type. PREIshare has a chance, and this is maybe where the greatest value is for the company itself. PREIshare has a chance to have all of that information in near real time. Yeah. And I think both buy and sell, valuation, and operating information, certainly on a monthly or quarterly basis.
I think just the idea of a trade happening that's an indicative price because it happened is something that it doesn't even exist.
Yeah. It's going to kill those gotcha moments.
Yeah.
In the industry. They were kind of fun. It was back when there was the wild, wild west. But now you're going to have pricing assurance pretty much when you go and make an investment, that you know what's going on and the value is correct.
Super. So, Michael, this has been amazing. The last one, this one, can we do it again sometime?
Anytime. Arthur, I love chatting with you. You ask the most intelligent questions. You make me think, so.
Wow, it's really flattering. I'll try to take it gracefully. And thank you again. Thank you all for being, you weren't with us today, but you were with us in our thoughts, but we'll be hoping that you get to enjoy this as we have and view it and share it with others. And we'll be sure to make sure that it's easy to contact Michael and his team if you want to participate. So till next time, as I always say, thank you for sharing with us the only thing you can't make more of, and that's your time.
Thank you.